Hey, what's up? What's up, everybody? Okay. Um, I'm so excited because I'm doing this for the first time. Okay. And I don't even know if we're doing this correctly, but if someone is watching this, just say hi. Okay. Um, okay. I'm here with my friend, joint venture partner, Curtis. Curtis, say hi.
Hello, hello.
Curtis from Hudson Partners. And Curtis, Ken, and I are actually buying a property in Indiana, Fourth Wayne. Okay, right?
Yep,
So,
Indiana, Fort Wayne.
what we're going to do now is that number one, I told Curtis we're going to have fun. If we don't have fun, it's not fun. Okay, no boring stuff. Right?
Yeah,
But we're gonna talk about fun stuff. We're gonna talk about Indiana. We're gonna talk about the deal. We're gonna talk about multifamily. I love to talk about taxes because I think that taxes is a painful thing if you don't do it right. Do you agree, Curtis?
yeah. It's a painful thing until you learn how to use it to your advantage. Yes,
Right? I mean, have you ever write a check, like a six-figure check to the IRS?
I have, and it was the last time I ever did that.
When was the last time you did that? Before
About
multifamily or after?
it was before multifamily, but it was definitely one of the leading reasons, to learn and get into this space.
Me too. Me too. You know that I'm not. I'm American citizen. Okay, I am totally American citizen. I have four, five American children. But before I was moving here, I lived in Panama for 7 years, and before I was born in Venezuela, you don't pay so much taxes there. So I didn't know the rules on the taxes, and then my husband and I were making some money, and then we have to write a six-figure check, and we were like, how does people don't do that?
Right.
I know you hear you hear that people don't do that legally, and then you are like scratching your head how people don't do it. And then I hear the other day that Donald Trump paid $500 in taxes. Do you hear that?
I have heard that. Yeah.
And the girl that was saying that, she said that was wrong. If I was his CPA, I would have gotten zero in taxes.
Yeah. Yeah. He paid too much,
He paid
right?
too much. That's
Paid
what she
too much.
said. That's what she said. But he also owns a lot of real estate too. And so then I discovered multifamily, Curtis, and then I started investing in real estate, and I started learning so much about
Yeah.
taxes as well, right? Mhm. And how to use it. And I still have so many conversations with people that they don't understand um, how much money they lose for no compounding, okay, when their CPA made a mistake,
Yeah.
and no compounding that money and investing that money. And that brings us to multifamily too, because if you get your taxes right, and instead of overpaying in taxes, you pay the right amount legally, right? And then you invest that money in multifamily, for example, and then you get all the depreciation from multifamily for the deal, like for example, for the deals that we have for other people, but better
Yeah.
if you invest with us. Mhm. Then, okay, you can get more, okay, taxes benefit because you're investing and you're getting more money. Does that make sense?
It does. It does. You essentially control, right? It's gaining control of your tax picture, in that you and your team, your CPA, your financial advisor, uh, you get control of that. And that's the whole point here, and how we educate people not only on what multifamily is and the great returns, this industry has, but really the benefit that a lot of people aren't aware of, which is the tax advantages, right?
Now, this is a good time to say a disclaimer. Okay, I don't know if you know the disclaimer by memory, but we are not financial advisors.
Yeah.
Please consult your CPA. And all investments has risk. So I don't know how, I don't have a ability to share the screen, but we are saying a disclaimer right now. Mhm.
Yep.
So let's talk about multifamily and the deal that we have together, Curtis. This is a new market for Venus Capital Partners. And as you know, I used to live in California several years. We never invested in California. We never buy anything in California except for our own house, which, by the way, we're trying to sell, and it's like 40% down prices.
Yeah.
No? In California. And now we live in Texas, beautiful Texas. And Venus Capital has properties in five different markets, including the Midwest. But this is our first time going in Indiana. Okay. But you guys has been in Indiana for, like, I mean, you live in Indianapolis, can live in Indianapolis. You have several deals there. Um, I know this, but can you tell people that is watching, what is about Indiana that
Yeah.
you guys like so much?
Yeah, I think most people think of Indiana and Ohio as flyover states, right? Everybody's flown over them on the way to New York or the East Coast or West Coast. I was born and raised in Columbus, Ohio. Now, I did go live all around the world, and I'm super fortunate to have experienced Europe and Australia. But when I wanted to come back to my roots, which was investment banking, real estate, numbers, it made a lot of sense to not follow the shiny object, right? And the non-shiny object, or the turtle versus the hare, the turtle in this analogy, that is Indiana, Ohio, that is the Midwest. It is one of the best places to invest in real estate because you have markers like 40 years of 2.9% rent growth. Well, that's not sexy, right? Like, some other markets, Phoenix, parts of Texas, and some other places.
Awesome.
But what it is it's very predictable. And I think there's a lot of East Coast, West Coast money now finally realizing and putting the spotlight on the Midwest. Well, we've been here for a long time. We know how much renovations to do because that will get this much rent increase because we own 12 assets in we call them the donut counties around Indianapolis. And so it's those little nuances when you're underwriting or modeling a deal, how much to spend, how not to overspend, which property managers to work with. And in this case, right, we're not using a third-party property manager. We're using our own Hudson Residential Company. And so that's why we love the Midwest, is it's on nobody's radar until recently. And now everybody's trying to come in, but nobody has the knowledge that we do, right? And so we're the most sophisticated shop at this size, under 250 assets in this area, right? And so that's why we love it.
I totally agree with you. You said something very interesting. You said that it's predictable. Okay? It's predictable. And some of the things that happen in many markets in Texas is that they were very sexy, like Dallas, Austin, what are, like, probably Houston as well.
Yeah, even San Antonio. Like, it was hot for a while.
It was San Antonio. It was hot for a while. Yeah, it was impossible to buy something in San Antonio or Austin or Dallas. And then on the other side, in Arizona, Phoenix was like that as well. But you will see like a double-digit rent increase. And now they all have negative rent growth.
Yep.
Crazy. It's crazy.
Yeah. And Indianapolis has been just the darling over the past 5 years of crazy interest rate run-ups. Right? It's always in top rent increases. And it's just because there's just a massive lack of supply. And on top of that, nobody can build. And then it's number 7th, right, in the country. It's probably lower now as cost of living. And so now that the world opened up and people can work remote, or where do you want to raise your family? there's just so much industry and job growth and population growth coming into this area, and it's gonna be a nice 10-year run, in this market. And so that's why we're happy that this is home base and headquarters for us.
Yeah, and that's another good point here. You said that it's home base for you, which I love because you guys are there and you're watching over all the investments in Indiana. But do you also invest in other places that are not Indiana?
Yeah, so we do, right? I would say most of our assets are Indiana, Ohio, and Kentucky, right? Especially since we launched our property management company, keeping things within a 3 or 4 hour drive as we expand our portfolio. But we have an asset in South Carolina as well. But I would say if we look at the next 2 years, especially with what we know about Eli Lilly, one of the biggest and best companies in the country, and what they're investing in the state of Indiana and all these different growth sectors, that it makes the most sense on what the macro data is telling us, as well as having our own internal property management to stay local, Indiana, Ohio, and Kentucky. And I think we're going to be rewarded for it, right? And take Fort Wayne for an example, where this current deal is. Outside of, if you live in Indiana or Ohio, nobody knows Fort Wayne, Indiana. Nobody knows that it's the second largest city in Indiana. And nobody knows that they've had a massive renaissance, over the past 5 years in investing billions of dollars into their downtown and tax codes to get industry to come back. And we've known that. We've been trying to get in this market for a couple of years. And we got this opportunity at our doorstep here. And once again, we were not the winners. The winners of this was a New York syndicate. Yeah.
So we had one winner. Okay, that's a super funny story. We had one winner, and then that person back out, and then the broker came back to the top two firms. Yep. Okay, and what those firms were Hudson Partners and Venus Capital.
Yeah. Yeah.
And then we were competing each other. We didn't know.
Yeah.
We didn't know that until you got the deal. And I got the call from the broker, and he was super embarrassed. Vanessa, I'm so sorry you guys didn't get the deal. But you know what? We had to go with these buyers because they have some other deals that in Indiana. And I was like, that's Kent. And
yeah.
I knew it. And then we talked, and it's like we are doing the same deal, and we didn't have to underwrite the deal. We had all the data. We were so excited to do this joint venture with you guys. So people like to invest where they live.
Yeah.
And I kind of understand that, but I don't, because when I live in California, I never invested in California, right? Did you see a lot of investors like that they want to go and see the property with you?
I would say it's still like, if we have 80 to 90 people invest in our deals, it's still the minority. Like, I would say 5%. So, right, 90 people, maybe 4 people want to go tour it. Now that's who asked me. I don't know if other people go drive it and go look at it, but yeah, it is there, but it's not like a driving force, of the investors. I think a lot of them like you to know that they can go drive it, but then they don't do it, right? Because there's a psychological play there and I think it works. Like, if they know that it's local, they know you're local, it's great. But we've got over 400 investors in our deals, and I would say about 200 of them are Indiana based. And so those people are very excited to get into this deal because they've been waiting for an opportunity in the Fort Wayne market, because they live here their whole life, and they know the growth that's been happening up the street.
That's exactly my point. I think that when people know the market and they live in the market, they probably has more knowledge about the potential of the market as well.
Yeah.
Same here, and I have investments in many other states, but same here in Texas. Okay, um, people is still looking for opportunities in Texas. Okay, and they feel like, and I think there are opportunities, Curtis. To be honest, I think there are opportunities in Texas, especially now that there is negative rent growth. Okay, in cities that has been over,
Yeah.
like the
Over.
rent growth has been,
Yeah.
yes, for so many years, like Austin or even San Antonio as
Yeah.
well. Okay.
But that's what I love about this is the CAGR rent growth for the next 5 years is expected at 7.8%. That's the
Mhm.
expected next 5 years. And I have a feeling that that's conservative. But like we talked about in our underwriting, we're only using 2.8% in our underwriting because that's following the 40-year trend of 2.9%, right? And, it gives us a lot of runway to overachieve on a market that's in our backyard.
Yeah. So I'm very excited about that. And let's go back to this deal and the bonus depreciation. Okay.
Yeah.
Touching base on what we were talking at the beginning on the taxes. So this year, July 4th, okay, Donald Trump signed the big beautiful bill, and now we have back the 100% depreciation. Okay. And many people does not understand how does that work. Okay. Why don't you explain a little bit about that?
Yeah, you know, like before we lost bonus depreciation, let's go 2 or 3 years ago, right? There's all these tax codes out there that let investors or let syndicates like us, we can hire an accounting firm and essentially we can look at every window, the square footage of the parking lot, the refrigerators, and we are allowed to bring those forward to 1 year, 3 year, and 5 year buckets. And because this isn't a REIT, you actually invest in this deal and you own a percentage of it as an LP. You get your percentage of that accelerated depreciation. Well, back 2, 3 years ago, for every $100,000 that was invested, right, you were getting back, I call it 53 to 60% of every dollar. So 100,000, you would get around a $60,000 in a K1 loss. Well, over the past couple of years, the bonus depreciation has stepped down to zero, and that had lowered to about 35 to 38% of every dollar. So you used to be able to invest 100 grand, get 60,000 back in a K1 loss. Recently, it's been about 35,000 on a K1 loss. But now in 2025, we are back at those higher numbers. We're roughly, we always like to be conservative, somewhere between 48 and 60%, in those K1 losses, which allow you as an investor to shield any of your K1 gains that you have. And if you don't have K1 gains, it sits on your ledger until we have a capital event when we sell the asset. And at that point, you can use the losses to offset your gains there as well. So it's just one of the only asset classes out there that gives you and your team the ability to strategize, right? If you sell equities, you're going to pay 15 or 20%. It just is what it is. There's no way to shield that. And there's no way to sell out of an equity, get into another equity, and pay no taxes. And so you're stuck in that one equity. Maybe that's Meta, maybe that's NVIDIA, whatever it is. And then all of a sudden, you're not diversified. And so I just love being diversified in real estate, in the multifamily space, having those K1 losses far more than I would on individual stocks.
Well, and diversification, I mean, I'm all about diversification. Right? If you own stocks, you should own stocks.
Yeah.
You on crypto, okay? But I do know that the wealthiest people in the world has at least no less than 40% of their assets in real estate, no less. And they also own a lot of private equity. private equity, real estate, private debt. Okay. And I I was actually Curtis at a event, in a Tony Robbins event, in a business event, and he was talking about how in 40 years the stock market have never been close to the returns that private equity real estate has offered. Okay. Not even close. So I think it's important diversification, but people don't know that these kind of opportunities are available to. They don't know that they're also available on even you could invest with your 401k and with your IRA.
Yep.
And people don't know that. So, well, this was fun, Curtis. I have a question for you. Okay, why do we see a bed? Are you in your bedroom doing this live?
I today I am in a guest bedroom, and luckily, it's nice and clean. It's got, I think that's icebergs from Australia, one of the most famous pools in the world in the background. So it's a very tranquil place in here.
Oh, that's awesome. Well, isn't that one of the beautiful benefits of real estate working from home?
Yeah, it is. Yeah, it is. You can work from anywhere you want, and really just, one of the reasons I love it is just, I think there's financial illiteracy is an issue in this country. And just like you said, explaining to people that you can use self-directed. What does that even mean? What are the benefits of a traditional or a Roth? Like, we don't do this for a living, right? And we stated that earlier, that you have to consult your financial advisor, your accountant, but we do this with our own money, Vanessa. Like, this is our own money, right? So we know all these things because we've been doing this for a long time, and we're protecting our own money and our family's money and our friends' money, right? And, as we go along.
Right. Yes. And I think that people, I'm going to mention this because we're very active on real estate. People talk about passive income and passive income on real estate. And in reality, it's not passive for us at all. This is a very active job that we have. We do all the work. Okay.
Yeah.
Like analyzing hundreds and hundreds and hundreds of deals to find this one, to due diligence, buying the property, making the fund together, putting the investors together, implementing the business plan until we sell. Okay. So we are very active. This is not passive for us at all. Okay. Yeah. However, it is passive for the investors that come with us. Okay. It is very passive for you as an investor. And I know this is live stream, and I don't know how our team is going to do that, but I guess we're going to drop the link for people to check on this investment. And if you're interested, we're going to drop a link here somewhere. Okay, here somewhere. So you can click there and check on the investment and reach out to us. And if you want to learn more about how this is going to help you, how it can help you, investing in your investments goals, or even how does the segregation work, just let us know here. Okay. And thank you so much, Curtis, for doing this with me for the first time. And I think that my marketing team is going to ask me to do this again. So
yeah, I would say let's do it again. And now that we tested out, your team learns. I'd love to do this again next week, and we can get a little more into the deal. But I like these little 30-minute windows. This is fun.
That's awesome. And now I'm gonna go and jump into my pool for a little bit, and then I'm gonna come back to my office, which is here on the back.
I love it.
Thank you, Curtis. Goodbye, guys.
See ya.